Now that we've got a better understanding of inflation, it's time to examine what everyday Americans can do to protect your savings and retain your purchasing power amid those higher prices. Joining me in studio for more is Joe Orff, Wealthstream Advisors Director of Investment Research. Joe, thank you so much for being here. I appreciate it. Let's start on the inflation picture here. You really want a Goldilocks scenario, not too hot, not too cold. Explain to us why it would be a bad thing for prices to drop rapidly, because right now that sounds pretty good.
Yeah. So it's an interesting question. So for prices to drop rapidly, we'll see inflation come down. So everyone's seeing this inflation report that's coming out later this week. We're expecting 3.4% inflation. It's coming hotter than expected this whole year. At the beginning of the year, there were estimates that the Fed could cut rates 6 times this year.
Yeah.
Now that expectation is down to 3 hikes, potentially. There's a lot of up in the air scenarios about where inflation is going to be and where it's going to go from here. And one of the main sticking points is really the housing impact and the rental cost on inflation. How rental costs haven't come down as quickly as everyone thought.
Yeah. So again, though, in terms of for our audience that's looking at this from a wealth perspective, I am curious about what consumers can be doing to hedge against inflation. For a consumer that right now has all their money parked in their bank account, what could they be doing differently?
Yeah. So the one thing that we recommend to all of our clients is to move money out of your normal checking and savings account that's really paying you pennies on the dollar, moving it either into an online savings account, Ally Bank, Barclays, Discover, Amex. If it's a savvy investor, they could even buy direct Treasury bills that'll yield a little bit more.
Okay, so that's 2 parts to that. One, how do you decide the right high yield savings account for you? Should you just go with the one that has the highest yield?
So I don't think you should go with the one with the highest yield. There's some online savings accounts out there that are advertising 6, 7, 8% yield.
Yeah.
That's significantly more than the Fed rate of 5%. So there's going to be some additional risk in there. You might not see it today, but if everyone wants their money out at the same time, there might be an issue with getting your money out of some of those institutions.
There might be a liquidity issue, right? And you have to make sure it's FDIC insured as well. That's a big component that you mentioned. Buying Treasuries, how good does your investor hygiene have to be to go from that next step, right? Not just high yield savings, going into CDs, going into Treasuries.
Yeah, so Treasuries, you definitely have to be more on top of it. So you buy a 3-month Treasury yielding, say 5.4, 5.5% right now. 3 months goes by, you're going to have to manually buy another one. You have to set alerts up for yourself to constantly roll those Treasuries. Whereas if you put in an online savings, it's a one-time transfer. You don't have to touch anything again.
Okay, and then last question for you. I'm curious about asset allocation varying across different age groups. Right now we have this record-breaking rally in the stock market due to AI and big tech. For those that are nearing retirement and their portfolios naturally kind of reallocate to be more bond-heavy than stock-heavy, should they go in and manually change that?
So it depends. So the way we look at client asset allocations is on 3 factors: time horizon, required rate of return, how much money they need to earn to accomplish their goals, and their risk tolerance. So some clients who are older might have a really high risk tolerance and they'll be okay owning more stocks than bonds, and they're okay with big drawdowns, whereas other clients might not be. So to say it's a blanket answer, as you get older you should be more conservative, isn't necessarily the right answer.
Depends on that risk appetite. I love the idea of just setting my required rate of return. Like if I could do that, that'd be great. Let's make it 200%. Joe, thank you so much. Really appreciate you joining us in studio. Thank you.